Hi, everyone, and welcome. This is Betty Smith, Vice President of Communications here at CQG. Our webinar today is Trading with Ichimoku Clouds. And before we get started, as always, I'll cover some very brief housekeeping. During the presentation, we will be taking questions through the Q&A feature of WebEx. So when we're in the web conference view, please use the Q&A feature in the lower right-hand corner, and we will watch your questions as they come in, and we will address them at the very end of the presentation. When we're in full screen view, you can use that floating toolbar, and you can also submit your questions there via Q&A. If you have any technical problems, particularly with the audio at any point during the webinar today, please use the chat feature, and our host will get with you and try to resolve any issues that we may be having. Hopefully we'll have just great audio today. And I do like to mention that today's webinar will be recorded, and it will be available in a few days. All right, so with that, I get to introduce our speaker and guest for the day. It's Manesh Patel. So welcome, Manesh.
Oh, thank you. How are you doing?
Fantastic. And just briefly, I'll do a little intro on Manesh, and then I'll hand off the presentation. Manesh has a master's in engineering from Georgia Institute of Technology. He's worked for such esteemed companies as Lucent Technologies and Bell Labs, and then transitioned to becoming a full-time trader and launching the School of Ichimoku with EII Capital Group. Manesh's book is Trading with Ichimoku Clouds, which is the topic of his presentation today. So Manesh, with that, I will pass off the presentation to you.
Oh, thank you, Betty. And also thank you, Amy, for arranging everything for me to present today. Welcome, everyone. And as Betty just mentioned, today I'm going to go for Ichimoku. Let me move to the next slide. Just to start off, I just kind of want to briefly go through how I'm going to present today. Reason why, there's no way I could cover everything about Ichimoku in 30 minutes, especially all the different strategies that are out there, and cover every aspect of Ichimoku. So what I'm going to do today is I'm going to cover one of the main high probability strategies, which is what we call our cloud breakout strategy. And I'm going to go through that strategy in detail. And towards the end of the slide, I'm going to go for various instruments with multiple time frames and kind of illustrate that strategy on various instruments and various time frames. Also, with Ichimoku, you have 5 indicators on the screen. For today's strategy, we're only going to be using 3. So I purposely have removed the other 2 just so it's not confusing at all. But if you add the Ichimoku indicator on the CQG platform, you'll see a total of 5 indicators. For today's strategy, as I mentioned, we're only going to use 3, which are the most critical ones. And we're going to show you exactly how to use those for this high probability strategy. Okay? So I want to spend a couple of minutes going through the history of Ichimoku. Then I'm going to talk about the advantages of Ichimoku, and then I'm going to go into the differences between Ichimoku indicators and moving averages. A lot of people think the Ichimoku indicators are moving averages, but they're not. They have a huge advantage of the moving averages. So we're going to go through that, and then we're going to jump straight into the rules, and we're going to start looking at some particular instruments. The instruments we're going to look at, I took a snapshot of them last week. So we're going to look at various time frames, from daily charts to weekly charts to 60 minutes and so forth, even 1 minute for the day traders out there. And we'll look across different asset classes, from metals to commodities to stocks to even the S&P 500 futures and so forth. So I've taken snapshots of them and then on the presentation due to time. Okay, so if you have any questions, as Betty just mentioned, just type them in, and we'll definitely get to them as we go forward. But today's presentation should be very simple and should be very clear for anyone to pretty much understand. Okay, the very first slide I'm going to go through is the history of Ichimoku. If you look over to your left over here, this pretty much goes through and describes the history of Ichimoku. Ichimoku was founded by a newspaper gentleman in Japan named Goshi Osada. He basically started working on Ichimokus back in 1940s and finally wrote a book in 1968. At that point when he wrote the book was pretty much geared towards completely talking about Ichimoku, and Ichimoku at that point was used at that point for trend-based systems. So he created a system that basically where you could go out and you could find support resistance very easily and very, very fast. Okay, it really didn't become popular until in the 1968, and it didn't become popular until 1996 here, when Mr. Sasaki from the Nikkei Citigroup's Securities published a book called Ichimoku Kinko Studies. Today, it's in its 21st edition, and this book pretty much became very, very popular in Japan to a point a lot of Japanese traders today use Ichimoku to trade the currency market and also the Nikkei market. Okay, so the key points here is that basically all the books that you see from the original founders, from Hasada and Mr. Sasaki, pretty much written in Japanese. They've never really been translated to English at all, and this has been one of the obstacles in bringing it. There's been a lot of people interpreting all the different Japanese terms so many different ways and so forth, but if you look at the main books go through pretty much talking about all the Ichimoku indicators. Then they start going through all the wave patterns. The wave patterns that they go through are all the wave patterns that you see today, from head and shoulder patterns to double tops to triple bottoms and so forth, but they describe them in Japanese terms back then. There also is a timing element that's written in the original books that go through and talk about different timing elements in Ichimoku. I personally don't use those timing elements at all. I pretty much use Ichimoku for recognizing support resistance and for pure price action and so forth. For timing elements, I refer more back towards WD-GAN theories, price and time squaring, so that's where I use the time elements there, but I really don't use the time elements for Ichimoku at all. The key aspect here is that basically in Japan, this is for 9 consecutive years voted the best technical system out there. If you look in the Japanese trading rooms, Ichimoku is pretty much the most popular indicator that's used there, and it's called cloud charting there. Okay, so this kind of gives you a history of Ichimoku, a very simple history of what's been going on there. But remember, the Japanese mainly use Ichimoku to trade currencies and to also trade the Nikkei market. They really didn't venture into using Ichimoku for futures market or the U.S. stock market at all. And this is one of the reasons why it's been slow to come to the Western world, is a lot of charting packages that we had here really didn't offer it until the last couple of years. Now, Ichimoku is pretty much a standard indicator out there, so all you have to do is go into your CQG platform, you could add the Ichimoku indicator, and it's readily available there for you. Okay. Next, we're going to discuss are the advantages of Ichimoku. Why is this very unique compared to all the other indicators out there? And there's a lot of indicators out there, but we're going to go through and kind of highlight some of the key points of why Ichimoku is a huge advantage. The very first thing is that Ichimoku works for all time frames. If you've been reading up on Ichimoku, some people say it doesn't work for day trading. It does work for day trading time frame. You can then trade Ichimoku down to a tick level, 1 minute level. It works on 2-hour charts, 60 minutes, 4 hours, dailies, and weeklies. So today I use Ichimoku to trade all asset classes for multiple time frames, even down to tick level charts. Okay. The next advantage is it does work across multiple asset classes, so this does work on all instruments out there. We use Ichimoku not only trade the U.S. markets, but we also use it to trade global markets out there, from Singapore, Malaysia, India, to Canadian stocks, to U.S. futures, to currencies, and so forth. So Ichimoku is an indicator that the asset class out there globally. Okay. The next main point of Ichimoku is that this is the biggest huge advantage out there. It's a visual-based system. It's so easy to look at and so easy to understand that it's very, very easy for people to understand and use. It's very easy to even teach 14-year-old kids the system now because it's a pure visual-based system. And once we go to the charts, you'll see exactly what I'm talking about. There's a cloud on the screen. And once you see price in respect to that cloud, you're instantly going to know which way you could trade it. Whether you could trade it going long, being bullish, whether you could trade it going down, being bearish, or you shouldn't even be trading it at all because it's entered a consolidation pattern. So this visual aspect of the cloud that you're going to see on the screen gives it a huge advantage over many systems out there because it's pure visual based. And it really doesn't clutter up the screen at all either. Okay? Next, the system is purely a pure price-based system. Okay, and we'll talk about that once we get into the indicators. But the system has worked in the past. It will work today, and it'll definitely work in the future because it's based on pure price action. And we'll talk about more about that once we get into the indicators. Next, there's various strategies to the various different profiles of traders. Today, we're going to go for a trend-based strategy called the cloud breakout strategy. There are counter-trend strategies there. There are short-term strategies, long-term strategies, and so forth. So there's various strategies out there. Within EII, we basically have narrowed it down to 4 strategies that we use for all the different trader profiles. Okay, we're going to go for one of the strategies today, but we do use 3 other strategies outside of this. 2 of them are counter trend, and 1 of them is more shorter term, long term trading. Okay, Ichimoku and Japanese. And if you basically look at Ichimoku, the whole idea of Ichimoku is simplified trading to a point you're just trading the probabilities. The whole idea is to go in, analyze a chart, within a second, determine the sentiment, determine if you could sit there, if you should be trading on this going long, short, or consolidating. Once you know the sentiment, at that point you could sit there and put an order out there or not put an order or move on to another instrument. The whole idea was to go out and find the trend-based opportunities out in the market and be diversified. Okay, so the whole idea of Ichimoku with the visual system is being able to analyze a chart and from anywhere from 1 to 3 seconds and determine if there's an opportunity there. So the system is meant to keep everything very, very simple. Okay. Next, and Ichimoku has a huge component to it. And one of the reasons why you could do forecasting with Ichimoku is that the indicators are all based on the high or the low of a bar instead of the closing price. So we do not have to wait for bars to close at all. We could actually determine where price needs to be in order for all our indicators to be good. So this allows us to forecasting where we could put an order out there and wait for the market to come to us, and at that point we know we'll get in with all our indicators looking really good. And we'll talk more about that once we get into the indicators. Okay? The next component deals with money management. A lot of people don't talk about this on the web, but with Ichimoku, with the 3 indicators that we're going to discuss today, we're going to talk about this too, which is a money management component for Ichimoku. As a trend-based system, the goal is to have low risk, high reward. So when we look at our strategies for Ichimoku, we're always looking for a high reward risk ratio where we're risking $1 to at least make $3 per trade. Okay, and we're going to show you exactly how to do that with the strategy today, and we'll talk about reward risk ratio with money management as we get to the charts and talk about the strategy. Okay, next, volatility is already built in the system. And the reason why volatility is built in the system is that the indicators look at the high and low of the day. So the indicators actually incorporate the volatility within a bar. Whether you're looking at the daily chart, 1-minute chart, 5-minute tick, whatever may be the case, the indicators incorporate the volatility within a bar and is used towards the calculation. So as volatility increases, you'll see that your stop actually increases too. If volatility decreases, your stop decreases, so you have a lower risk. Okay, so it's very, very key, especially now with volatility entering the markets across all the different asset classes, that you have indicators that have volatility built into them, so they automatically adjust as the markets change. So will the indicators, and you'll see that with Ichimoku in just a moment. And lastly, we do not use any other indicator at all besides Ichimoku. We're solely Ichimoku traders. We do not use any momentum indicators, no oscillators, We don't use Fibonacci, no Elliott wave, nothing at all. What you'll find is that Ichimoku actually incorporates all the other systems within itself. If you look at the Ichimoku levels, the clouds and stuff like that, they actually are built with Fibonacci in consideration. So if you look at the cloud, you'll see that it is a 50% retracement or other Fibonacci values. You'll also see Elliott wave patterns built into Ichimoku automatically. So there's no need to incorporate any other system or any other indicator with Ichimoku at all. You could find everything that you need with the indicators built within Ichimoku. Okay? So now I'm going to go for moving averages. This is a simple slide. I'm sure everyone has seen moving averages, used moving averages. You're probably using moving averages today or some other indicator that's based on closing price. In this example here, I've got 9 bars on the screen. Doesn't matter what time frame it is. And if you look over here, I basically have taken the closing price of all 9 bars, averaged them together, and that gives me the value, and that's the indicator right there. And you could see that basically the moving average here for 9 bars is pointing up. Well, this is a huge problem for moving averages because moving averages are a delayed indicator, okay? And if you could see, the current bar right here has not exceeded the high of this bar right here, but yet the moving average is still pointing up. A lot of people will look at this scenario and say that if the moving average is pointing up, you still should be bullish and you should be buying or entering more positions and so forth. Okay, and this is a delayed reaction in the moving indicator, and the reason why you're having this delay is because moving averages use closing prices. Okay, also moving averages when they use the closing price, they're not really incorporating the volatility within a bar. Okay, and you could see that especially if you look back at a lot of daily charts or higher time frame charts from when the flash crash happened in 2007, you'll see that a lot of the indicators that were based on closing prices were still pointing to be bullish, and that was not right. And what happens is for like a week to 2 weeks, depending on the time frame you're looking at, you were getting a lot of false signals with moving average or other closing price based indicators. You're not going to see that with Ichimoku at all. It's based on the high and low, and we'll go into that indicator in just a minute. Okay? So quickly, I'm going to go through this. Ichimoku indicators I call are more range indicators. And the reason why is in Ichimoku what they've done is they take the 9 bars, and instead of looking at the closing price, what they does is it takes the high of the range. In this case over here, it will be this one. Then what it does is it takes the low of the range, and then what it does is it divides by 2 and gives you the midpoint. So when you see an Ichimoku indicator, it's basically the midpoint of the high of the range plus the low of the range divided by 2. Okay? And the reason why we do this is, one, this is the 50% retracement if you think about this in terms of Fibonacci. Okay? But we do this reason why in Ichimoku we want to know when we're breaking the support resistance. Okay, so if this indicator is flat, this is telling us that the current bar high and the current bar low are within the range for however many bars we're looking at. In this example, it's 9 bars. If the Ichimoku indicator was pointing up, that's telling me that the current bar high just exceeded this bar high right here of the last X number of bars. That means we just broken resistance and price is starting to move up. So it gives us an alert and say, hey, come and look at this chart. We just broke resistance. Something's going on. If this line was pointing down, that means basically we just broke support. And it basically, if we break support, it's giving us an alert and saying, hey, come look at this chart. Maybe there's an opportunity there because price is right around support resistance and we just broke it. Okay? So the whole idea of Ichimoku is to look at these indicators and to see if they're flat. If they're flat, it means we're in a consolidation mode for that range. If they're pointing up, that means we just broke the resistance for that range. If it's pointing down, that means we just broke the support of that range. Okay? Also, when you look at these indicators, the more flat they themselves are support resistance values, because if you think about this, this is a Fibonacci value. So when you see these indicators and they're flat for a very long time, that's a major support resistance within itself. Okay, so we use these indicators for two things. One, to tell us if we're breaking support resistance, and two, the actual indicators represent key support resistance values for us. Okay, and here you could see this basically represents support resistance going back 9 bars. Okay, now what I'm going to do is I'm going to show you the screen. This is kind of like a screen full of information here. So let me break down this information. Okay, this yellow line, let's go for the green line first. This green line here is basically the range of 26 bars. A minute ago we talked about the range for 9 bars. This green bar basically is the range for 26 bars. So we take the high of the last 26 bars, we add it to the low of the last 26 bars and divide by 2, and that basically gives us this green line. Now this green line is very, very critical. Reason why, this is the container of the trend. When we enter a trend, this is what we're going to use for a trailing stop. Okay, we're not going to use this exact green value, but what we're going to do is use a buffer off the green value. And up, you would use this green line minus a couple points below that as your stop. As this green line goes up, your stop increases too. Okay, so this acts as a trailing stop moving forward. If you're betting on the instrument going down, what you'll do is use the green line plus a couple points as your stop. Okay, and basically this green line is the container of the trend. Okay, that's very, very critical because this is what we're going to use for our money management. This is what we use for our risk to reward ratio calculations, everything. Okay, so this is one of the 5 indicators on Ichimoku that's available. The next 2 indicators we're going to go through are this white line and this yellow line that make up this cloud. Now in CQG, when you add the indicator on the screen, they give you different colors. Okay, I like these colors, so that changed my colors here. So when you add the indicator and you get different colors, don't freak out or anything like that. Just remember, there are different colors when you add the default settings on there. For me, these colors suit my eyes, so that's why I've changed it there. Now, in order for you to see which one relates to yellow, the indicator that looks the most flat is always going to be the equivalent to my yellow on this screen. And what that represents is the range for 52 bars. Everyone okay with that? Okay, so when you see this yellow line, this represents the range of 52 bars. When you see this white line, this roughly represents a range for 18 bars. Okay, so on the screen you got a range for 18, 26, and 52. Okay, now that should be pretty clear with everyone. So, you know, take into the rules. Each of these lines act as support resistance, as we mentioned earlier. Also, if all 3 lines are pointing up, that means our high of today has broken, or the high of the current bar has broken the range for the last 18 bars, 26, and 52. So that's telling you that a trend is already occurring. Okay? Now, the trick part of Ichimoku is that, and you're probably asking this question right now, is that why do we have this future cloud? Well, if you look, most indicators and everything, the indicators go to this bar right here. They do not have a future component at all. And what happened is that when this Asada basically developed Ichimoku, he basically said past patterns repeat themselves. So in order for you to determine what's going on today, you don't need to be looking at the current support resistance, but you need to find what the support resistance that affects today's prices from the past. So that's why he created this cloud. So when you're looking at this white line and yellow line, and you're saying, okay, this yellow line represents the range of 52 bars, that value is actually written here, 26 bars into the future. So if you look at this yellow line here, that's taking today's range, going back 52 bars, and calculating the range for 52 bars and plotting that value here. So when you look at the price here and you look at the cloud right below the current price, these values are all actually from calculations from 26 bars ago. Okay? So if you think about this yellow line here, which is right below the current price, this calculation here is basically 26 bars ago, and then it goes back another 52 bars to find the range. So this is over 70 plus bars of range right here. Okay, so you could see everything that's going on. So you could see that when you look at this price and you're comparing to the cloud right below it, you're comparing it to support resistance from the past. And the reason why you're doing that is because we're looking for past patterns to repeat themselves and see how they're going to influence today. And you're going to see how powerful that is in just a moment. Okay? Now, this is very, very critical for you to understand. Don't worry about why 26. I know a lot of people asking about 26. A lot of people say, why did he project this cloud 26 bars into the future? Why is it not 28? Why is it not 30? A lot of people think 26 comes from the number of trading days in Japan, the rice trading days, and so forth. That's not true at all. 26 actually has to do with astrology and so forth, and I'm definitely not going to go through that in this call at all. If you want to find out more about that, we could talk about that offline, but we're not going to go for that number at all. But you'll find that 26 is a very, very critical value, especially for trading. Not a lot of people look at it, but Ichimoku, the whole foundation of Ichimoku is actually based on the value of 26. Okay, and it's a very, very, very key element here. This cloud is projected 26 bars into the future. One of the indicators I don't have on the screen is projected 26 bars back into the future. So 26 is a very, very key element for Ichimoku moving forward. Okay. Now, here's the simple rules I'm going to go through. Okay, when you see price in this cloud, okay, that means the closing price is in this cloud. That basically means the settlement is consolidating. That means you cannot bet on it going up or cannot bet on it going down. If you see the closing price above the cloud, that basically means you could bet on this instrument going up. If you see the price below the cloud, the closing price below the cloud, that basically means you could bet on this instrument going down. Okay? So that's a simple rule for the sentiment. So right away, within 1 second, you could flip to multiple charts, and you could determine right away what the sentiment is for multiple instruments. Just by looking at this price bar, see where the closing price is in respect to the cloud right below it. Not in the future, but right here below the cloud. Okay? Now, the key part is that this cloud represents volatility. It also represents key support resistance values. Okay? Now, the key part in trading with Ichimoku, one of the key first strategies is that you want to look for a scenario where price is in this cloud or on the opposite side of the cloud. I look for scenarios where price is in the cloud then comes out. As soon as you get a scenario where price was neutral, the sentiment was neutral, and the very first time it closes above the cloud or below the cloud, I now start looking for that particular instrument and start looking for buying opportunities or selling opportunities. Okay? Reason why, this is when the institutional wave is about to begin. This is basically when the major trend is about to start. It will not start in the cloud. It won't start below the cloud at all. The majority of the time, the true trend will start as soon as it transitions out of the cloud. So if you're looking at bearish scenarios and looking for bearish opportunities to balance out your portfolio, you'll look for the very first time when price closes below the cloud, and that's when you start looking for a sell signal. On the bullish side, if you need some bullish positions, you'll start looking for when the candle here, the current price, closes above the cloud, that's when you start looking for buying signals. Once you enter the instrument, you then use this green line as basically a trailing stop, and you stay in this trend until price crosses over that green line and gets to your stop, which is basically the green line minus the buffer, in this case for a bullish opportunity here. Okay, so in Ichimoku, you're not trying to be a psychic where you're going to say, well, it's going to go to here or there or anything like that. Remember, it's a trend-based system. And the goal of the system is to keep you into the trade for maximum profits or for minimum loss. Just like every trend-based system out there, the goal is, if you're right, you want to get maximum profits. If you're wrong, you want to minimize your losses as soon as possible. And that's exactly what the system does. You get in right when it comes out of the cloud, and then you use the green line as a trailing stop and allow the system and the market to tell you when to get out. And we're going to start looking at multiple asset classes and time frames in a minute so you could see exactly how Ichimoku works for different time frames and different instruments out there. Okay? Now, one key thing I want to stress to everyone. Your entry needs to be as close as possible to this cloud. Reason why is the best reward risk ratio that you're going to get from money management is when your entry is closest to the cloud. The further away you are from the cloud, the worse your risk reward is going to be. If you start to enter here, remember this is hindsight where we're seeing price action over here. You don't know if it's going to end here, here, or here. Okay, and if you enter here, this is far away from the cloud, really, really far. That's dangerous.
Hi, Manesh. It's Betty. I just wanted to mention, I think you're meaning to advance slides, and
okay.
We're on the Ichimoku indicator slide range,
okay.
which is slide 8. So if you're still on that slide, fantastic. I just wanted to make sure.
Oh, wow. Okay, there's been a delay. I'm glad you told me.
Okay.
I've been looking forward.
Yeah, I know.
Do you see the cloud
now?
now?
Looking at the next slide.
Okay, thank you. I guess I'll talk about the slides at the top. Okay, so the slide should say Ichimoku Cloud, SKA and SKB. This right here, I'm sorry about this. I thought the slides were advancing forward. This is the future cloud which I was talking about. This is where all the current calculations are written. This right here represents the price in terms of the cloud right now, and this is what you're looking at to determine the sentiment right now. Okay? Let me catch up real fast. If you look here on this slide here, this basically the title says instrument sentiment, and this is where just what I was talking about a minute ago. When price closes above the cloud, that's when you first start looking at it. When price basically is below the cloud, this is basically you could only bet on it going down. If price is in the cloud, this basically means it's consolidating. Okay? So basic rules, again, here, we've already gone through this. You're going to start looking for scenarios when they come out of the cloud, and that's when you're going to start looking for opportunities, okay? And if you look here, these are the rules here. If you look here, and this basically sets it, all the rules are here for this basic strategy. You look for price to be out of the cloud, coming out of the cloud, and close outside the cloud. Now, you're not talking about the high of the bar breaking out of the cloud or anything. You have to close outside the cloud in order for the sentiment to change. So you have to look at the closing price, okay? Once you get that, then you have to determine what your entry is going to be. There's two types of entries, of course, with different personalities out there and different trader profiles. One could be a breakout where you're going to wait for a pivot to form, and then you're going to enter with a pivot plus a buffer for bullish or pivot minus a buffer for bearish. If you're a pullback trader, then what you're going to do is you're going to wait for price. As soon as it breaks out of the cloud, you want it to pull back either to a green line or a yellow line, and at that point, you enter the trade, okay? The reason why the pullback levels in Ichimoku are the green line or the yellow line, the reason why these are the strongest Ichimoku indicators out there. Remember, the green line basically represents the range for 26 bars, and the yellow line basically represents the range for 52 bars. And the key thing, let me remind you, is the more flat these lines are, the stronger the support resistance is, okay? So if you had a line, a green line that was only 2 bars long, and price pulls back to that, that's not a key support resistance. You got to have this green line flat for a while or this yellow line flat for a while in order to be a key support resistance, okay? And remember, the other aspect is you have a trailing stop. You're not going to use this green line, but you're going to use a green line minus a buffer as your trailing stop, because you'll find a lot of times price will come to that green line and bounce right off there. So you have to use a buffer off that green line as a trailing stop. Okay? So now I'm going to go through various different instruments and different time frames. And remember, a lot of these snapshots were taken last week, so don't have the last 2 trading days on here because we prepared the PowerPoint at that point. So take that in consideration when you're looking at this. This is basically crude oil here. If you look here, a couple of opportunities here. Now remember, when you get these spikes here, doesn't mean you're entering right here. Remember, you have to wait for a bar to close, and when this bar closes, that's when you're going to start looking at opportunities. If you're a breakout trader, you're going to wait for the pivot to form, and then the price of entry will be here. If you're a pullback trader, you're going to wait for it to come here or here and to enter the trade. Okay? So you're going to start looking for opportunities where it comes out of the cloud. And if you look here, it came out of the cloud, you're going to start looking for opportunities in here for a sell signal. And if you look here, you're basically going to ride this all the way down. Over here, you can see it breaking out of the cloud, came out of the cloud, and then kind of consolidated a little, went up a little, and then went down. Okay? So you could see here in these type of scenarios when price consolidates, the system, the green line, moves up very, very fast in order to basically get you out. If this thing is not going to go and decides to consolidate, you're going to get out for a little profit or a minimum loss during a consolidation pattern. Okay? Now, there are other rules, minor rules that you can add to optimize this strategy. We're not going to go through them due to time. I'm just giving you the basic scenario, which is a worst-case scenario, which are these three indicators with the basic rules. These basic rules are enough for you to be profitable, believe it or not. All the other techniques that you add on these rules are optimization techniques. Okay? You look at opportunities here, coming out of the cloud. Look at opportunities here, coming out of the cloud, opportunities here and here. Okay? And of course, a lot of these fake breakouts that you see, you could filter them down more by adding multiple time frame analysis. And that's what we do in Ichimoku trade. We basically use multiple time frame analysis with Ichimoku strategies to determine when this is basically a fake breakout, it's not going to work. Okay? Let me flip to the next screen. This next chart here is basically gold, Globex weekly. If you look here, the very first time you look here the gold, a lot of people started hearing about gold when it was basically at 1,600 and so forth, which is right around here. If you look when it first broke out of the cloud, where it was bearish and in the cloud, it was back here in 2009. And if you look here, basically this is when you should have sat there, got into gold. And this, remember, this is the weekly chart, so this is for long-term portfolios. Okay? You would get in here, you would not get stopped out here because your buffer would have covered it, and you'll stay in here and you'll get out here. Okay? Now, remember, there's optimization techniques which you could sit there and tighten up your stop and you could get out here, but the worst case scenario, if you just follow the basic rules, you'll get out over here. Okay? This next slide is gold on the daily chart. You could see the swing coming in and out. You could see a transition here where it came out of the cloud and started a trend. Over here, it came out of the cloud. The pivot was here, which is too far away. You could have looked at a pullback. Look at a pullback level here. You could have had a pullback level here to this yellow line, but look at that yellow line. It's not flat for a very long time. In fact, it starts going up. You want pullback levels where this line right here is flat for a very, very long time. Okay? So you're looking for those type of scenarios. So you start looking only when price comes out of these clouds, and that's when you start looking for strategies or entry points to get in. Now, what you can do is if you have a strategy within yourself, you could sit there and apply it right when price comes out of the cloud. You could apply your own strategy over here. Okay? If you look here, this is Globex, this is copper in a 60-minute. You can see the lower time frames on this one. You get a lot of volatility going in and out around the clouds. And if you go to a higher time frame, you could filter this out. Okay? But this is why you time Ichimoku with multiple time frames when you're day trading to kind of filter out scenarios where you're going to have a lot of volatility and fake breakout. But you could see if you time this correctly with higher time frames, you can get on major trends going up or going down. And you could see they all start happening right when it comes out of the cloud. For people that are Elliott wave traders, this is basically the 2 to 3 wave is when it first comes out of the cloud. That's basically the 2 to 3 wave, which is the institutional wave. When it pulls back to the cloud and then bounces off there, that's basically the 4 to 5 wave moving forward. Okay? So again, we're just going to go for various things, various instruments and time frames because we're running out of time. This is copper over here. This is a chart of copper, 15-minute chart. You can see for day trading, you've got a little movement here, going up. You said there's a couple of points you could make within this basically trend here. There's opportunities here. You can see these wild swings that you're going to get every so often. This is why you have to time it with multiple time frames in order to be successful, especially now with all the high-frequency systems out there and automated strategies, behavioral finance black boxes. You've got to be very careful in the lower time frames and make sure you're keyed in with the higher time frames. Okay, this is basically EuroFX, GlobeX. This is 1 minute chart for basically the euro currency, and you can see the movements here coming out of the clouds and so forth. Now remember, this is one strategy here coming out of the cloud. There are other strategies that you can incorporate later on after you hit a consolidation pattern, and we're not going for that right now. Okay. This is the daily chart for the euro, basically USD for the FX side. You can see the nice long trends here, and remember, it'll allow you to pretty much stay into these trends as it comes out of the cloud. Okay. This is my favorite one. This is one that we actually were in for a very long time. Look at natural gas when it came out of the cloud. It was going down, 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 then it consolidated. There was another opportunity here to get in. So the first opportunity was here. Second opportunity was here. And then notice it came down, down, down. You would get out here, consolidate it. You had another opportunity to get in here. And notice it just kept on going down, 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 down. A lot of people, when it got to 2, were basically saying it can't go lower. Or actually, when it got to 250, you said you couldn't get lower. For us, we just kept on following our green line all the way down, and we stayed in this trade, basically going all the way down. Okay? This is another one that we were in, basically gasoline. If you look at it here, basically beginning of January of this year, look at gasoline. Came out of the cloud and basically gapped up. As you know, most wave 3 patterns start with a gap. So if you see it coming out of the cloud and you see a gap, most likely that's going to start a wave 3 pattern for Elliott wave, which is a big institutional wave that's getting ready to go. And if you look here, it gapped up, it broke these pivots, which are major resistances, kind of hung around there, and then took off. And this trade, you would stay in all the way up to here. Okay? Now, this is stock, GE stock. You can see everything coming out here. A lot of the stocks, as you basically saw, were basically bullish here from the beginning of this year going forward. But actually, middle of December, we actually put out buy recommendations for U.S. stock market to start buying stocks right before the beginning of the year. And you could see one of the opportunities here. Okay, this is U.S. Treasury Note futures. You could see here, you could basically apply Ichimoku for Treasury Notes and bonds too. There's buying opportunities here, selling opportunities here, and so forth. So you could just look at these charts and you could see all the opportunities were there. Remember, you're going to get a lot of fakes like this, but you got to sit there and you time it with multiple time frame analysis, and when you do, it'll filter out a lot of these fakes. This is coffee. This is one of our great trades this year. Even on Twitter, we blogged this here. We were basically waiting and waiting at the December for this thing to break down. It didn't, and we finally got a trigger right around here on a lower time frame. We entered this, and we basically rode this thing all the way down. Okay, this is a great trade. Now, a lot of people talked about coffee at the beginning of this year. A lot of people have been focusing on natural gas, crude oil, and so forth, but this was being a nice trend going down and a good trade that basically gave a good reward-risk ratio going all the way down. This is showing you a daily chart, but we actually entered on a 2-hour chart, and this actually gave you a 7 time frame sell, where this was a 10-minute, 30-minute, 60-minute, 120, 240, and a daily sell signal all at once that occurred on our signal system. This is another one that we entered, sugar. This is the chart last week. You can look at sugar now. It's broken down. We entered this right around here on a pullback right around there, and this is a daily chart. We actually entered this on a 4-hour chart, but it was right around here. We entered here, and you can see sugar now. You can even see sugar still going downwards right now. So this is a live chart that we're in right now. And that's it. I've gone through pretty much all the instruments out there. Do you guys have any questions for me?
All right, Manesh, we do have some questions, and I just wanted to say it was really great to look at using Ichimoku with kind of different instruments over multiple time frames. That was really wonderful. So let's get right into our first question is from VY. Should we watch for any move out of the cloud, regardless of direction or cloud color, or are there specific directions from certain clouds to watch for?
Okay, so let me, I think that was a twofold question, and ask the questions if I don't address it. When it comes out of the cloud, the color of the cloud here really is irrelevant. The color of the cloud over here in the future is what's relevant. And that's another rule that you can add for optimization. And I'll just give you that rule real fast. If you're betting on this instrument going down, this white line has to be below the yellow line. If you don't have this there, then what's it going to do is cause a pullback in the wrong direction of your trade. So if you're betting on this going bullish, my clouds here are yellow. Okay, yeah, I think the default values are blue and red. So the default value, a bullish cloud in the future would be blue, and over here for a bearish scenario it will be red. So you want to sit there and look at the future cloud here, but not the color here, wherever the current price is, really does not matter at all.
All right, fantastic. And then we did have an earlier question, and I think this was before you said you'd address it offline, but just are the 18, 26, and 52 bars special in some way?
Well, you know what, I'm not going to go for 26 because you guys will probably think I'm crazy start talking about astrology and lunar eclipses and stuff like that. So definitely I'm not going to do that with all these participants there. If you want to talk to me offline, you can. But, you know, one of my key things I tell my students and people I talk to and present to, you know, a lot of people say, well, you know what, let's change the default indicators from, you know, from the 26th, 9 and so forth, because they represent trading days from the old days in Japan. They don't actually. And my thought process to everyone on this call and everyone else worldwide is that do you want to spend time doing research, playing with the values, or do you want to spend time making money? And I can tell you this now, with the default values, you can make consistent profit across multiple asset classes and multiple time frames very easily.
You know, Manesh, your presentation was so straightforward, I think I might be able to do it. But I have to remind everyone that we don't give any trading advice here at CQG. That's on your disclaimer as well. We do have a question from Andy. Do you prefer not to use continuation settings?
When you say continuation settings, are you referring to the future cloud?
I'll have to wait to hear from Andy on that. So there might just be a little bit delay as we look to see. So I'm going to move to another question, and then we'll see if Andy circles back with us. So we have a question from Joel. On the sugar number 11 chart, is the June period shown as a bull run?
June period, are you talking about now or in the past? If you're talking about now, basically the sugar is still going down right now. If you look at an active chart right now, this is a daily chart where we took a snapshot last week. Remember, this is in April. We're in May right now. You'll see sugar has moved down to another leg down. So right now for June, the price is way below this cloud, so it's still bearish. And it was going to be a long time it's going to be bearish. And the only way this thing can go bullish is it's got to get above the cloud. And we're far from that. You're talking about sugar is actually below 2100 right now, I believe.
All right. And although I haven't heard back from Andy, I did have someone else pipe in and say, I think what he means by continuation settings is continuation charts in futures across multiple months or contracts.
Well, that question comes down to, you know, dealing with futures and stuff like that. The way I look at it is You can look at a contract, continuous contracts, of course. Looking at a chart with continuous contracts is the ideal thing to do. If you need to look at the individual month and year contract, that's fine. But the key thing is scroll backwards and make sure you have enough history where the Ichimoku Clouds and the indicators have enough values in them to be drawn. If you see a chart and you scroll back and you see a half of a cloud, that means the formula doesn't have enough bars to do the calculation. Remember, these calculations go back a long, long time. You don't have to scroll to find support resistances. They're all built here. But it's got to be able to reference bars. It's got to at least be able to reference 200 bars when you're looking at one screen full. And if you're looking at a particular contract date and month, and there's not enough 200 bars there, then you're not going to get enough values to form these indicators.
All right, and I apologize, everyone. It does get a little bit confusing when you're not able to address your questions directly to the presenter. Andy himself chimed back in and said continuation meaning the rolling front month contract or the contract by itself. So.
Yeah, I mean, Andy, I try to look at continuous charts as much as possible. Because it kind of handles the contract moving forward. But like I said a minute ago, if you need to, you could look at a particular contract date, month, and year that you're looking at. As long as it's got data to fill out the Ichimoku charts, you could still trade it. You're not going to see much difference at all. Of course, when you get the rollover, you got to basically be able to adjust the charts from there to there.
Excellent. I have a question from Michael. In your book, do you discuss how to filter out using different time frames? Are there a few that you like?
Yeah, time frame analysis is a huge research project that a lot of companies do. We've done a lot of research on time frames and what we call fractal wave trading. In the book, we go through we talk about all the different strategies, and then what we do is for like the EURUSD in the spot market, we talk about back testing with one strategy and show you how to back test and then optimize and stuff like that. We don't really talk about multiple time frame analysis at all. The reason why that could get really, really ugly writing it in the book because, you know, when you write things in the book, it could be interpreted so many different ways, and we don't want to confuse people. You know, the time frames that we look at are, you know, 10 minutes, 30 minutes, 60 minutes, 120, 2 hours, daily and weekly. If you're scalping, then you could go down to a 133 tick chart or 600 tick chart, and those are the values that we look at. You know, you got to find out what each time frame gives you, how many points they give you. If you're looking at the currency market for spot market, and you're trading a 10-minute chart, we know that the average profit that you get on a 10-minute on the currency is 20 to 40 points. So you got to know your values, and you got to know what the average trend values are for the minimum max. If you know that, then you can easily sit there and trade those and do multiple time frame analysis. When we trade a 10-minute, the time frame that we look at is always a 2 hour for the 10 minutes. Because that's it's what we call fractal waves, one wave within another wave. So we've done research in that, which basically shows you that those two time frames syncing up with each other.
All right. And if you're all right, Manesh, we'll take a few more questions.
Yep.
All right. So from another Michael, can you use candle formations to get a lead on a potential change in direction?
You can.
Yeah.
You can, and that's why I kind of left the presentation vague and say this is when it closes below the cloud or above the cloud, that's when you start looking for entry opportunities. Every trader is going to have a different way of entering. Some may want to use candle formation. Some people look at pivots for pure price action. Some people are very aggressive. They're just going to say, I'm just going to go as soon as it comes out of the cloud. So, you know, I want to make sure that when we talk about everything, it's catered to all the different trader profiles. So you still could use your existing trading system here. The key is just to look for opportunities when they first come out of the cloud, and then you could trade your own personality and profile that way.
All right. I think we'll take about 2 more questions from KW. Are there any trade reentry rules if you've been stopped out but not re-entered the cloud?
With the strategy I went through today, no. unless it goes back into the cloud and everything. The other strategies that we talk about that are there, you do have them. And there's one called what we call a high probability strategy, where there's 4 rules to it. You can visit our website, Ichimoku Trade, and there's a video on there, and that will allow you to re-enter after you have a cloud breakout strategy that's finished.
Fantastic. Let's see, and wrapping up from Paul, am I clear, if a trade comes into the cloud, do I wait for the break or take that as an area of support or resistance?
Now, you have to wait for it to come out of the cloud. You know, what you look for is price to be in the cloud, and then once it's in the cloud, you look for a closing price outside the cloud, whether it be bullish or bearish. And that's when you start looking to enter. Not enter, but looking to enter.
All right.
The big difference between entering.
Fantastic. So we're at our closing slide. Everyone can see that you can reach Manesh directly at either of these 2 emails. I do want to mention, because someone asked about your Twitter profile, so quickly, Manesh, what is your Twitter handle?
You could actually, if you just go to Ichimoku Trade here, you could access our Facebook, Twitter, YouTube, everything that's out there, all our resources available there. So the website has everything that you need, and you could access there.
Fantastic. Manesh, I want to thank you so much for the presentation today. And I would like to let all of our participants know that if we didn't get to your question, there were some really good questions that came in. Manesh will follow up with you individually and directly. We did record the webinar, as we mentioned at the beginning, and that will be available in a few days at our news site, news.ccg.com/events. I would briefly like to mention that our next webinar on June 5th will feature Denise Shull, the author of Market Mind Games, who will be speaking on risk perception and making better risk decisions. So with that, thank you, everyone, and thank you, Manesh.
Thank you, Betty, and thank you, everyone, too. If you guys have any questions, just email me, and we'll go through them.
Perfect.
Thank you.